Revenue is one of the most important numbers on a company's financial statements, and it's oftentimes the largest number on the financial statements. If we take a look at Apple's most recent income statement, we see that revenue is $391 billion. These numbers here are in millions. If we add up revenues for the last 3 recent years, we get over $1.1 trillion in revenues. So clearly it's important to understand the accounting rules related to revenue recognition. Revenue is the increase in cash or accounts receivable. When a business provides goods or services to customers. The accounting standards for revenue recognition help us determine how much revenue to record and when to record it. Revenue is recognized at a point in time when control of the goods or services is transferred from the seller to the customer. It's easy to determine when control of services is transferred. It can be a little bit trickier to understand when the control of the goods is transferred. Okay, so revenue is either recognized at a point in time, over a period of time, or it could be some mixture of a point in time and over a period of time, as we'll see in our examples for this chapter. Revenue is recognized over a period of time if any of the following 3 criteria are met. Number 1, the customer consumes the benefit of the seller's work as it is performed. So an example of this might be cleaning services or any type of utility. We can think of internet services, electricity services. They're consumed as time passes. And that's one area in which we'll recognize revenue over a period of time. Another is when the customer controls the asset as it is being created. And an example of this would be a building. So company hires contractors and construction workers to put together a building for its purposes, and it has control over it, and it has control over how it's designed and how it's coming out, and it controls that specific asset. Even if it's not actually using a partially completed building, it has the ownership of it. Another area when revenue is recognized over a period of time is when the seller is creating an asset that has no alternative use to the seller, and the seller has the legal rights to receive payments for progress. And the seller has the right to receive progress payments. Okay, so an example might be if a company receives a contract from the government to design and manufacture fighter jets. And let's say it's Boeing is the company, and it's creating fighter jets for the US government. Well, even if the US government changes its mind, there's really not much else that Boeing can do with those fighter jets. So it's going to record the revenue as it is creating those jets. Contracts may have multiple parts or multiple components to them. And that's what we're going to see in most of our examples for today. Contracts may have multiple parts that require revenue to be recorded at different times. And that relates back to the accounting standards help us determine here in this third bullet point how much revenue to record and when to record it. Before we go forward, just some terminology. A company's promise to provide goods or services to a customer, we're going to need to be familiar with this, particularly if you're going to be working in audit. You're going to become very familiar with this term. The promise to provide a good or service is called a performance obligation. And we're going to be using that term. It's just a fancy way of saying the company needs to provide goods or services to the customer. And when we look at a contract, we need to determine how many distinct performance obligations. What are the specific parts of this contract? When are they going to be provided to the customer? And that's going to help us determine when we're going to record that revenues. The idea is to separate a contract into the specific components, that those parts can be viewed on a standalone basis. How many specific mini contracts do we have inside of one typical contract? That way, if we can separate a contract into specific standalone components, the financial statements can better reflect the timing of the transfer of each standalone unit of that contract, and profit on each one can be earned once each standalone performance obligation has been satisfied. There's 5 steps to the revenue recognition process that we need to remember. The first step is to identify the contract with the customer. A contract with a customer, it might be a written, exactly what we're all picturing, that legal document of a contract, but it could also be oral, just spoken between the two parties, and it could be implied when two companies are doing business regularly. Let's say a company is hiring another one to do landscaping, and it's just implied that at the end of every month or on that weekly basis that the landscaper is going to do their job. It assumes that there's a contract. Step 2 is identify the specific performance obligations in the contract, breaking it down into its parts. Again, it could be one performance obligation or it could be several. The third one is determine the transaction price. We're going to look at some examples where it's not so clear what that transaction price is. There might be some variable components to it. Step 4 is allocate the transaction price to each specific performance obligation. And then finally, we're going to recognize revenue as the performance obligations are satisfied. So this first step, identifying the contract, that's a little bit of an analysis, requires a lot of judgment. We're really going to focus mostly on figuring out how many performance obligations are there and how do we determine the transaction price when it's not specifically identified in the contract. It might depend on some estimation of events that could happen in the future. The allocation is a bit straightforward, and recognizing revenue is simply recording those journal entries. Let's start with examples 1 and 2 that look at identifying the performance obligation in the contract. Example 1 says TrueTech Industries sells Tribox, a gaming console, which allows players to play video games individually or in a multiplayer environments over the internet. A Tribox is only a gaming module and includes no other goods or services. The company sold 1,000 Triboxes to comp stores. Record the entries for each of the following events. On December 20th, 2026, comp stores, the customer, orders 1,000 Triboxes at a price of $240 each, promising payment within 30 days after delivery. On December 20th, really nothing has taken place. No economic transaction has taken place here. All that has happened is that the customer ordered and the company, Tribox, hasn't done anything. So they haven't received cash and they haven't delivered anything. So there's no journal entry. There's no cash, so we don't have debits of cash, and we can't increase accounts receivable because nothing's been delivered. Next, on January 1st, TrueTech delivers 1,000 Triboxes to the customer. The title of those goods transfers to comp stores. So let's record the entry on January 1st. This is just your typical revenue recognition entry. So we're going to debit accounts receivable because the company has not received any cash yet for an amount of 1,000 units times the price per unit of $240 each. So accounts receivable is going to increase by 240,000, and we're going to record sales revenue because we've just delivered these goods to our customers. Okay, our journal entry is increase accounts receivable, which is going to, of course, increase our assets. Each time I record a journal entry, I like to think about how did this journal entry affect the financial statements. Assets went up and revenue on the income statement went up. January 25th, the company receives $240,000 cash from the customers. So our journal entry is, of course, we receive cash of 240,000 and we decrease accounts receivable. And what happens to the financial statements? Assets increase with the receipt of cash, but we decrease assets with our credit to accounts receivable. Example 2. TrueTech sells 1-year subscription to the TriNet multi-user platform of internet-based games. Record the entry on January 1st when TrueTech sells 1,000 subscriptions for $60 each. Now, again, this is a kind of a typical type of transaction we might see in an introductory financial accounting class. Though this is a 1-year subscription, we're receiving the cash on January 1st, so we increase cash, 1,000 subscriptions, 1,000 units times $60 per subscription. So cash goes up 60,000, but remember with subscription revenue, we're going to provide it over the course of 1 year evenly. So we're not going to record revenue at this point. We're going to increase the liability account, deferred revenue, also known as unearned revenue, which tells the users of the financial statements, we owe our customers $60,000 in goods or services in the future. So a debit to cash, of course, is going to increase our assets. And a credit to deferred revenue, don't forget, this looks like a revenue account on the income statement. This is a liability account. We're going to increase our liabilities. This is one liability that investors want to see because it's going to lead to future revenue. Okay, the next item here is a question, and it says, would additional entries be recorded related to the sale of the 1-year subscription? Of course, over time, the company is going to record the revenue as time passes. Most companies are recording their journal entries at the end of every month, although outside of the firm, the investors won't see the impact of the journal entries until quarter end or year end. But yes, TrueTech, the company, will record the revenue earned each month. And that journal entry, not that it's asking us for this, but that journal entry will be a decrease or a debit to the liability account deferred revenue. This is a 1-year contract, so we're going to divide it by 12 months. And every month we're going to recognize $5,000 decrease to liabilities. And we are going to increase our service revenue, or simply the revenue account. Credit to revenue is going to increase our revenues on the income statement. And the next item is a question, what would the year ended 12/31/2027 balance sheet and income statement report related to the 1-year subscriptions? Okay, so we would have received cash of the full 60,000, the 1,000 units. So it's a 1-year subscription. We'd have the full cash. We'd have no balance in deferred revenue. Each month, the company would decrease the deferred revenue and record an increase into service revenue. So the balance sheet would report the cash. And the income statement would report service revenue of 60,000.